In this article, we will explain how you can achieve long-term financial growth. Let's start with bank deposits and savings accounts, and what makes them absolutely useless. Unfortunately, with each year the profitability of bank deposits decreases, yield rates on deposits go down, and in some countries, they even reach the inflation rate. Let's take a look at an example from Germany. According to a survey conducted by the Bundesbank, 58% of banks have set negative interest rates on deposits for corporate clients, and 23% have done the same for retail clients. The survey was conducted at the end of September, a few weeks after the European Central Bank reduced the interest rate on deposits from -0.4% to -0.5%. Although the return on investments is still officially above the inflation rate, their real return is effectively the same as the level of inflation. In order to achieve returns that are higher than inflation, real returns, you need to seek out more profitable options that are often riskier. So if you want to maintain or even improve your current financial status, you need to start learning about investment instruments as soon as possible. In this article, we will discuss traditional instruments as well as lesser-known instruments that are no less reliable. When talking about investments, stocks are usually the first thing that comes to mind. That's why they are a good starting point for this discussion. Stocks are securities that give their holder the right to receive part of the company's revenue. In other words, they offer an opportunity to purchase a share of a company. Stocks are a long-term instrument, which means that you should hold them for at least a year, ideally, for several decades. This offers the opportunity to increase your capital by several times. It's worth noting that in the entire period between 1872 and 2018, there wasn't a single 20-year interval in which investments in American stocks following the buy-and-build strategy have led to losses, even when adjusting for inflation. On the contrary, one-year investments often resulted in losses. A study by Business Insider features a list that offers an illustration of this principle. Its authors calculated the amount of money that you could have earned by the end of 2019 by investing $100 in stocks from giants such as Nike, Coca-Cola, McDonald's, Microsoft, Apple, Amazon, Starbucks, and Netflix during their IPOs. A graph showing the growth in the price of Apple stocks offers visual confirmation of the long-term potential of this instrument. The company created an IPO on December 12, 1980. The price of stocks in the company started at $22. As of this writing, the price of one stock has gone up to $317. Some people believe that it is difficult to earn a lot on stocks, and certain investors forego long-term investments in stocks entirely because of their low profitability. Nevertheless, there are some exceptions in the market, which are usually related to high-tech companies. It's worth noting a recent increase in the stock price of Tesla, which some traders even called a stock bacchanal. In early February, Musk's company stocks experienced an insane leap. In the evening on Tuesday, February 4th, the price increased from $674 to $970, only to drop back to $734 the next day. These sudden changes were not caused by news about Musk's crazy exploits, sudden revenue growth, or launches of autonomous vehicles. Before moving on to our next instrument, here's a quote from the Investor's Manifesto by William Bernstein. The most that can vanish with any one stock is 100% of its purchase value, whereas the winners can easily make 1,000%, and exceptionally 10,000%, inside of a decade or two. Advice: diversify your stock investments to ensure that your investment portfolio contains stocks with the highest growth potential. Statistics show that a properly diversified portfolio should contain between 10 and 14 stocks. Fewer stocks will expose you to higher risk, while a larger number will reduce profitability and make it more difficult to manage. Advantages: low risks, the potential for high long-term profitability. Disadvantages: long-term for return on investments, low or negative returns in the short-term perspective, additional expenses on services provided by brokers, hosts, and managers. Prices are affected by multiple factors which are difficult to control, from management decisions to political events. In the simplest terms, bonds are like IOUs. They can be released by companies and entire governments in need of additional funds. When purchasing bonds, technically you give out a loan, which is an investment in the development of the bond issuer. Naturally, investors purchase bonds in the hope of making a profit in the future. All conditions, including the purchase price, the payment amount and timing are discussed at the time of purchase. What sets bonds apart from other securities is the opportunity to evaluate